So let us talk about the deferred taxes on accrued pension expenses, because this is quite a different rule than look at first sight. So when you deal with accrued pension expense for the pension paid to a pension fund under the GloBE rules, the only premiums that you actually pay can be deducted from your GloBE income for the year, not what you've accrued. And the GloBE rules say that that's to align better with local tax rules. Quite frankly, I don't know which countries are referred to here, but I am not aware of countries where you say that you must only deduct for tax purposes what you pay, not what you accrue. Anyway, so let us say that you've accrued 100, but you've only paid 70. Then you would need to add 30 back to your GloBE income. As I just said, the difference in the P&L needs to be reserved. The issue that is complicated is that what you now get is you get a divergence between your commercial accounts and your GloBE income, and it may or may not align with the tax accounts, but just for accrued pension expenses. They don't say anything about accelerated depreciation or anything like that. It seems as though the deferred tax calculations work slightly different. The same kind of rule kicks up in corporate reorgs and things like that, but we'll deal with that later. For now, I just want to highlight the deviant difference on the deferred taxes in the GloBE income for accrued pension expenses. And there is an issue where they also talk not about only the payments that you make to a pension fund, but apparently when pension funds are very profitable, you can also earn income from such a pension fund as an employer who put the money into the pension fund, and they also deal with how that fits into the formula. We touched very briefly on that in this video, but not in detail. And then finally, if you control the pensions yourself, then you are out of this rule, and then you get back into rules about, for instance, that you can only deduct the pensions when you pay to the employees or something alike. Let us get into the rules and see what's going on. So if we look at what the GloBE rules say, we start with Article 3.2, which says adjustments to return of the GloBE income. A constituent entity's final is adjusted for the following items to arrive at the entity's GloBE income or loss: accrued pension expense. And then Article 10.1.1 defines accrued pension expense as means the difference between the amount of the pension liability expense included in the financial accounting net income or loss and the amount contributed to a pension fund for the fiscal year. So in other words, you can actually only deduct for GloBE income purposes that which you've actually paid to the pension fund, not that which you have accrued to be paid to the pension fund. Now, if we look at the administrative guidance that has been given on this article, it talks about divergence of GloBE and accounting carrying values, right? So it says under Article 2, under subsection 2.1, there are cases where the GloBE rules require a constituent entity to determine GloBE income by reference to a carrying value that may be different from the carrying value reflected in the financial account. So you get this divergence. The following articles are affected, and then it starts by mentioning Article 3.2.1i for accrued pension expenses. And it goes on to say, on paragraph 7, if the GloBE income is calculated based on an asset or liability's carrying value that differs from that used to determine the deferred tax expense accrued in a financial account, then any deferred taxes expense is no longer appropriate for computing the total deferred tax adjustment amount for GloBE purposes. So you need to do something different, all right? Because the timing differences between the tax accounts and the GloBE income will not be the same as the timing differences between the commercial accounts and the taxable income. And then it goes on to explain that any deferred tax asset or liability must be computed based on the GloBE carrying value and then adjusted in accordance with the relevant accounting standard and the deferred tax expense or benefit. And the subsequent adjustments must be used to compute the total deferred tax adjustment amount, where the GloBE carrying value of an asset or liability is adjusted to be aligned with the tax carrying value. The result will be that the related deferred tax expense will be disregarded. And this is effectively what happens with this accrued pension expense. And we will look at examples to see how this happens. Now, let us look at this example from the OECD. It says ACO in country A is in scope of the GloBE rules. ACO established a pension fund in country A for its employees. So it's a third-party pension fund, right? Country A imposes a 15% corporate income tax, and under the local tax rules of country A, deduction for pension liabilities are allowed in the taxable year in which the amount is contributed, in other words, paid to a pension fund, or in the case of pension benefits that are not administered through a pension fund, when it's paid to their beneficiaries. That's not relevant for us here because we only look at payments to the pension fund now. And then it says in year 1, ACO has an income of 100 and accrues pension expenses for accounting purposes of 20. In year 2, ACO has an income of 100 and effects a contribution of 15 to its pension fund. So in year 1, it only accrues, it does not pay. And then they work out the numbers. They say in year 1, ACO has a taxable income of 100, which results in a tax liability of 15. For country A tax purposes, the accrual of expenses is disregarded as no contribution is made to the pension fund. ACO created a deferred tax asset of €3, which is 15% of 20, because the euro 20 pension liability is not deductible for tax purposes until it is contributed. The timing difference will be resolved when the euro 20 is contributed to the pension fund because the deferred tax asset created for financial accounting purposes. ACO's income tax expense for year 1 is 12, 15 minus 3, which produces an effective tax rate of 15%. So let's look at this at the numerical example, right? We repeat this. We say they pay 20 in year 1. In year 2, they accrue 20 in year 1. They pay 15 in year 2, and the tax rate is 15. So our commercial financial accounts say we've got an EBITDA of 100. We do a pension accrual of 20. We have an EBT of 80. Now we need to calculate our current tax. Our commercial EBT is 80. We cannot deduct the pension accrual because we can only deduct what's paid, so we add that back. That's 20. So our earnings before tax for tax purposes, local tax purposes, 100, and we need to pay 15 in tax for that, right? So now we can put the 15 in current tax into the current tax of the commercial accounts. We do reverse a part of that because we've got a deferred tax asset. So instead of our final or financial net income being 65, it is actually 68. Yeah. In year 1, for GloBE purposes, however, things do not work out that well, right? Because in year 1, we've got a final of 68, right? We add back the tax, which is actually 12 minus 15 plus 3, so it's only plus 12. And then we reverse the pension accrual, which is 20. So we come to a GloBE income of 100 when we follow the normal rules. However, our tax is only 12, so that's 12%. So if we follow the normal rules, we will end up with a top-up tax, right? And the same thing, well, in not the same thing, the opposite thing happens in year 2. We have an EBITDA of 100, we have an EBT of 100. We only have current tax of 1275. If we look at what happened here, is we say we have a commercial EBT of 100. We make a payment for the pension accrual from the previous year of 15. So now our taxable income for year 2 is only 85, and the tax due on that 15% of 85 is 12,75. What we also do in the commercial accounts is we now release the deferred tax asset that we had here of 3. We're paying 15 out of 20, so 75% of 3 is 2,25, and then we come back to a final of 85. In year 2, for commercial accounts, we say we've got 100, we paid 15, so we only have 85, and we pay tax on the 85, that's 12,75. For pillar 2 purposes, we say that the final was 85, we add back the tax of 15, we reverse the pension accrual that we couldn't take the year before, So now we end up with a GloBE income of 85. We've paid taxes of 15, being the 12.75 plus the 2.25, which is 17.65% of our GloBE income. So clearly here we come with an excess tax in year 2, and we come with a shortage in year 1, which leads to an unnecessary top-up tax. And the rules that we are talking about are made to fix that issue. Now, when we look at the guidance that fixes this problem, you can see on paragraph 28 of the guidance, but it's going to be in the commentary to Article 3211, or to Article 32, I guess. It will be in paragraph 86. And only the bold text is new. The others have been there before, but let's go through it and see what it says. It says, the adjustment for accrued pension expense depends on whether the constituent entity's financial accounts, or the FANIL, includes an accrued pension expense or pension income with respect to the pension fund, right? We know that. In the case of an accrued pension expense, the adjustment is equal to the difference between the amount contributed to the pension fund and the amount accrued. The adjustment will be a positive amount if the amount accrued exceeds the contributions for the year. It's obvious because we add that back to the income. In the case of accrued pension income, the adjustment would be calculated as the sum of the pension income and the amount of pension contributions, if any, during the fiscal year. In this case, the adjustment will be a negative amount, right? So, as the way I understand it is, if your payments are bigger than your accrual, you're going to deduct some of your income because the payments are deductible. And then they come with a bit of a complex formula, but it works, but it's not pretty, right? It says the formula is you take the GloBE adjustment equals the accrued income or expense for the fiscal year. You add to it the contribution for the fiscal year, and you multiply that with -1. So the accrued income is the amount expressed as a positive amount, and obviously if you multiply that with -1, it's become a negative amount. The accrued expense is expressed as a negative amount, so that's going to become a positive amount, and the contribution is expressed as a positive amount, which again multiplied by -1 is a negative amount. I think this is the wording of the calculation is overly complex, but we look at the calculation and we'll see what it is that they intend to do. And then they also give further explanation. They say where the pension fund is in surplus and the surplus is distributed, that surplus will be included in the computation of the constituent entity's GloBE income. For the purpose of calculating the constituent entity's adjusted covered taxes, this is the important part, the deferred tax used in the preparation of the consolidated financial account should be excluded under 413A. However, a deferred tax expense relating to pension surplus should be included in the computation of the constituent entity's computation for adjusted covered taxes. Now, we're not talking about that last part because I'm already thinking that simply the difference between the accrued and the paid pension expenses are complex enough, and that's what we're going to stick to for this example. So let's see how this works out in numbers. So here we have our example and our numerical explanation. They are from before we made these adjustments. Let us now see what happens when we do the calculation the OECD style, right? So they say under point 7, the GloBE adjustment for year 1 is 20, which is the GloBE income of 100, right? And although ACO created a deferred tax asset of 3 for accounting purposes, the creation of that tax asset is ignored for purposes of determining ACO's adjusted covered taxes, not for determining the GloBE income, but for determining the adjusted covered tax assets, as there is no longer a temporary difference between the local tax position and the GloBE income after the GloBE adjustment under 321I. Thus, ABC GloBE's ETR for year 1 is now 15, and it's not 12 like it has been before. So let's see how this works out in the numbers. And it comes back to the very first part of guidance where they say for 3211I, you actually ignore the deferred taxes because there is a mismatch with the commercial accounts, right? So We still have an EBITDA of 100, we still have pension accrual of 20, we still have an EBT of 80. To calculate the current tax, we go to the commercial EBT of 80, we add back the 20 in pension, we come to 100, we come to a current tax of 15, which we plug into the current tax. We still calculate in the commercial accounts the 3 deferred tax asset, and we do end up with the final of 68. Yeah. For pillar 2, however, in year 1, we say we've got a final of 68, so we take into consideration a deferred tax asset. We only add back 12 and we add back 20, so we come to 100. But now when we take into account our adjusted cover taxes, we take into account as adjusted cover tax only the current tax. Here we ignore the deferred tax asset, so we end up with 15, and we end up with 15%, so there's no top-up tax in year 1, right? And then in year 2, if we look at the explanation on the left-hand side, in year 2, ACO has a pre-tax income of 100 and pays 15 to his pension fund, but accrues 0 pension fund expenses, so it's still only the 20 from year 1. ACO also reduces his deferred tax asset in respect of the pension from 3 to 0.75, because that's 1/4 of 3. For local tax purposes, ACO has a taxable income of 85 as a contribution of 15 to the pension fund is allowed as a reduction from taxable income, which results in a local tax liability of 12.75. And then we get to it under Article 321I. The pension expense has to be adjusted. This results in an adjustment to ACO's financial accounting as a final of minus 15 multiplied by this minus 1 thing, right? Which in turn results in a GloBE income of 85. Although ACO reduces deferred tax asset by 2.25 for accounting purposes, the movement in that asset is ignored for purposes of determining ACO's adjusted cover taxes, because if you're going to ignore the accrual of the tax asset, you also have to ignore the reversal of the tax asset. Otherwise, some things are getting out of balance here, right? Thus, the ABC Group's GloBE ETR for country A is 15%. So if we look at the numbers again, you've got the 100, you didn't accrue anything or pay anything, the EBT is 100. You paid 15, but that doesn't go through the P&L because you've already accrued it in the year before. You've got an EBT of 100, you plug that into your tax accounts, you calculate that there's a 15 deduction for the pension payment, so your taxable income is 85, and your tax on that is 12.75. You put the 12.75 into your current tax. You reverse your deferred tax asset for 15 out of 20, which is 2.35, and you end up with a final of 85. You then plug the final of 85 into pillar 2. You add back 15 for taxes, because you still follow the deferred tax calculations in your GloBE income calculation, but you ignore it for your adjusted cover taxes, right? So you then reverse your pension accrual, or you deduct it, and you end up with a GloBE income of 85. You ignore your deferred tax asset from your commercial accounts. You only take into consideration the 12.75, and you end up with a corporate income tax or GloBE income tax rate, effective tax rate of 15%, and there's no top-up tax in year 1 or in year 2. So this is what they want you to do for accrued pension expenses. There will be similar calculations for business restructurings and asset transfers, where there's a divergence between the commercial accounts and the GloBE accounts. The other upward or downward adjustment, timing differences with regard to accelerated depreciation and those things, this divergence do not apply. We apply the same calculation as we do at the top here, because it works out. There's no unnecessary top-up taxes due. Let's move on to the next topic.